global economic growth has slowed, and the latest figures from China and US are a bit disappointing. Even the IMF has predicted a hard year 2015, a difficult year 2015. What does that mean? I will talk about this with Stefan Schneider from Deutsche Bank Resarch. Mr. Schneider, what did the DBIX do in January?
Actually, the DBIX dropped by another 1/10 of a percentage point from 0.4 in December to 0.3. And if we look at the driving forces, it's mainly the US, where the ISM has dropped by 1.5 points, which is one of the weakest for the last 12 months. We saw also a small drop in the Chinese indicator, whereas the indicators for Europe and Japan actually continue to improve.
The falling oil prices are quite good for the world economy, but of course the oil-producing countries have problems with that oil price. What kind of long-term effects does the low oil price have?
I mean, it's first of all good for the countries we are looking at. I mean, these are all industrialized economies or big oil importers, so they should all benefit from lower oil prices. And some rules of thumb show that decline of the oil price by some 40–50%, like we have seen it or seen it right now, should add roughly 3/4 of a percentage point to global GDP, which is obviously distributed unevenly. The oil exporters are suffering. We can see that in Russia, but also other countries. And it might, in the medium term, have also an implications for oil supply, that some of the supply will be taken out of the market or not come on stream, which means that in the medium term, probably oil prices will recover somewhat to levels we have seen maybe in the middle of last year.
At the moment, the low oil price is a problem for the European Union inflation rate. Yes, this inflation rate and the aim of the ECB is to have an inflation rate of about 2%. What is behind this magic number of 2%?
Actually, it's a problem people would like to have because it means strong real income gains. Oil prices are down 9% on the year. This has driven the Euroland inflation rate into negative territory. The most recent reading was -0.6. So I think overall we should not really be too much worried about the drop. We should actually enjoy it, and we can see that consumers are taking advantage of it. We can see that consumer spending and consumer confidence is picking up. But the ECB is worried about long-term inflation expectations, and the concern is that the consumers and investors will basically start thinking that even in the medium term, inflation will be way lower than the ECB's target, which is slightly below 2%, and that might have an impact on their spending behavior, and it might also cause some constraints for monetary policy. So the ECB would like to see inflation expectations, which have most recently come down a little bit, but which are honestly not so much forward-looking to reconverge to around 2%.
What we have seen in January was that the Swiss bank, the Swiss National Bank, has abandoned the cap between euro and the Swiss franc. Why have they decided about that?
I mean, the Swiss National Bank's President Jordan made it explicitly clear. He said it was aimed for a certain adjustment period to give the Swiss industry, the export-oriented industry, time to adjust to the stronger Swiss franc. And the other argument, of course, was the policy innovation in Europe, meaning that the ECB at the beginning of January had decided to start a massive QE program, 60 billion per month, adding more than 1 trillion to the ECB's balance sheet. And of course, stemming against this one would have caused the ECB's, the Swiss National Bank's balance sheet almost to explode. Jordan just said if the inflows the SNB saw just in the first few days of January, if that had continued, the balance sheet would have grown by 100% of Swiss GDP within the first 6 months. And of course, that's then something where a central bank has to think whether that's a viable policy.
Mm-hmm. Will the ECB's bond purchasing program you mentioned lead to less confidence in the euro?
I mean, I wouldn't call it less confidence, but obviously one of the effects is that we'll probably see outflows out of the eurozone, because obviously the returns of bond yields are so depressed, and that some maybe foreign investors taking their money out of the Eurozone, maybe some European investors who start looking at treasuries or UK gilts will take their money out, and that will then cause the depreciation of the euro, which we have already seen in anticipation of the ECB's policy move. And given that the other factors, the other transmission channels of the QE are pretty limited in the Eurozone, I think the ECB is hoping for the effect of a weaker exchange rate, which will obviously lift inflation in the medium term and also should be beneficial for European exporters.
Loss of confidence is not the only problem for the European Union. At the moment, all eyes are on Greece. The new Greek government rejected the Troika and called for an end of austerity. That's what we will be talking about in our focus interview. You can watch this interview on dw.de/English/Made in Germany.